Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player.
Good day, all. Ira Epstein of Linn Associates with your weekend edition of your agriculture update. And this is for Friday, the 27th of July, 2018, and the ag markets are closed. The other markets are still moving behind me. As you can see, a down day in stocks, pretty much a down day in most of the metals. Dollar down a little bit as we're seeing some of the currencies rally. Next week, we have the Bank of England, Bank of Japan, and the Fed come out with their monetary policies. But in the grain markets, the beans are the story, obviously. They are getting supposedly some new buying out of Europe. We know that China keeps cutting back on everything they're doing with the U.S., and it doesn't appear that anything there is going forward. NAFTA talks should move forward much more aggressively than they have recently because the Mexican government appears to want to get a deal done. I don't know what that does with Canada, but we've heard that our government is more than willing to do a deal with just Mexico. Therefore, that offers some support to the corn market. A lot of our corn obviously goes to Mexico, and it helps our ideas on at least some agriculture trade between the three different countries. So we'll see what happens. If we take a look at the monthly bar chart of soybeans, you can see how the market has been rallying, and at least we're up for the month. We haven't had an up month in quite a while, as you can see. So we're up 12 cents. It's better than being down. And off the lows of the month, which was 810.5, we're now 860.5. So we have come back 60 cents. The resistance on this chart would be 969 3/4, which we all know is a hope and a prayer, but you just don't know. But that would be the resistance point on the monthly chart. On the weekly chart, you went from 1071 to 810.5 last week. You had an up week last week and another up week. Now, if you take a look, you have come down from this 1050 level, so this is a nice bounce. You'd love to get a 50% correction, wouldn't you, to see from roughly, actually it would be taken from 1071 to 810.5, and that would be what, $2.60? You add $1.30 to that, that'd be about 940s right through here if you could get it. I'm not saying you will, but if you think of Fibonacci numbers, you start getting feels for that. The first resistance will be getting over the last swing line high of 899.5 because right now the trend remains down. You have lower highs. The swing line defines these, if you will, these points on the market where the market bounces away. It looks at the previous week, determines should the line be drawn up or down based on whether it's a higher high week, a lower low week, an inside week, an outside week up, or an outside week down. There's 5 different variables. That's the beauty of it. It's always consistent. So to negate the downtrend, because it would take it out of the pattern of lower highs, lower lows, you've got to take out 899. Resistance is far up. It's in the right now the neighborhood of 962.5. You do have what's called a bearish setup in the moving averages where the short-term 18-week average is under the 100-week average. So this is a pretty important barrier. And again, that 950 area comes into that zone. When we look at Bollinger Bands, well, the market had stepped out of them. Remember what I teach here. Bollinger Bands typically will only be stepped out of 5% of the time. In fact, that's how the formula is built. I have taken and used a rule of thumb that each time you're consecutively out of it, and we can go back and count this, each consecutive week out of it counts as one of those percentage weeks. You were out of it there, but not here. Here you closed over it. So you'd have to come back over here, and you had 1 week out of it too. Now, the idea here, and you can see that was 3, and then you step back into the band, out, and now you're stepped back into the band. It's because what it does is it keeps you, if you understand the theory there, that maybe if you're still bearish, you can sell at a better point, or if you're short, maybe you can put back out your shorts at a better level when you're outside of the band. It does not mean the trend is changing. That's a whole different theory. When I look at momentum, momentum is flattened out, but if we can get this red number to start getting over 20, I could make an argument that it's turning up. And the fact that the market closed near the high of the week after a previous week up probably leads credence that if you take a look at the market early on Sunday night, my guess is you're going to see the momentum turn up on that. It's only Monday, though. Remember, this is going to go on a whole week's basis. It's different than a daily chart. In the meal market, instead of the Bollinger Band becoming the important number, what really became the number and took over was the 100-week moving average of closes, which is the green line you're seeing here. Unlike soybeans, you're not even trying yet to turn the momentum up. This is a bounce or a market that's sort of flattened out. It's out of the downtrend. It has a pattern of a higher high and a lower low. The bias remains down and the momentum remains down. In the soybean oil, similar to what we saw in the beans, you got under these Bollinger Bands, got back over it, under them, and now you've turned back over them. Similar to the whole bean complex, you haven't yet turned momentum to the upside yet. Resistance way back at 30.20, but a warning sign that the market has really stepped out of this longer-term downtrend would be just getting over 29.38, as it would break the pattern of lower highs and lower lows. In the corn market, you broke that pattern of lower highs and lower lows this week when you crossed through this 359.5. As you did that, you turned momentum up. So now what the market's got is it seems to be stuck at the 100-week average. Remember, it rallied to that before and then fell. It's rallied back to it, and what it does here, it's got two choices. It either tries to advance further and get up to the 18-week moving average at 375 3/4, or it starts breaking again. Either way, it's not in a downtrend anymore. This big swoop to the downside, all that momentum's out of the market, and now the market is what I'll call looking for direction. It's got a lower low and a higher high. Yes, the bias is down because you're under the 18-week average, but momentum is turned up. The wheat market is bullish. One simple word. I haven't been able to say that in grains in a long time. You have a pattern of higher lows, higher highs. Yes, you rallied back to the upper Bollinger Band the way you did here and here, and to get a break off of that is normal. And that's what the market's doing. It's pulling away from that. That doesn't mean it's going into a downtrend. The bias is up, support's near the $5 level, and momentum is up. This chart is bullish. In the cocoa market, this chart is bearish, but it today hit the combination of the 100-week moving average and the lower Bollinger Band. You are oversold as can be. The trend is down. I see nothing to stop short sellers from selling on rallies, but I would be surprised if you didn't see some taking money off the table today. In the sugar market, short, bearish. Lower highs, lower lows, riding the lower Bollinger Band, not even breaking away from it with momentum still pointing down. Remember, on the weekly charts, I don't look at overbought, oversold. I just look at which way the momentum is pointing. In the coffee market, you got up this week high enough to take out the 112.20 level. So now you're left with a pattern that's a lower low and a higher high. That puts you out of the downtrend. Yes, the bias is down because you're under the 18-week average, but momentum's pointing up. So it's a chart that I think now nothing. It's just looking for direction. In the cotton market, it is still on the weekly chart in an uptrend, but not on the daily yet. You have higher lows, higher highs. Momentum has flattened. The bias is up. If you get under 86.90, it's problematic. The market needs to clear this 89.89, and then what you're putting into the possible target range is 93.88. In the cattle market, you bounced away from this big break into what I call the line in the sand, the 18-week moving average of closes, and the market stalled. It got up near it last week, hit it this week, and just completely stalled out. I don't see a trend in the market. I see a higher high. I see a lower low, momentum up, bias down. Nothing's together. In the hog market, the momentum is down. The bias is down. Last week, if you'll take a look, the market hit the 100-week average. It couldn't do anything with it, and today it was able to follow through, or this week it followed through. But you still have the pattern of the higher high and the lower low. So you look at it all together, you ask yourself, what do you have? And for the first time in a long time, parts of the grain complex have found a value area. That's what I think is going on. Meats are still questionable. The soft commodities, especially the sugar and the cocoa market, still very much in the bear camp. You know, one of the things that we've done is we take everything that we have and we try to make it better for you by putting it into what we call our futures kit. Two versions of our charting software. One's web-based, one is Java-based. The different offerings that you all see me doing here, they're generally put into the futures trading kit for you. So you get all the different brochures, what we're doing, ideas. And of course, when you sign up for this, and it's free, you can also sign up for my research or the Linn research and so on. To do all this, either give my staff a call at 866-973-2077. You can call us at that number you see. You can go to our website at www.iraepstein.com, or you can click right up here if you're watching me on YouTube. It'll take you to the area to sign up. I'm probably going to start writing some metal reports next week, and I'm hoping to hold by midweek or so maybe one of the video conferences I like to do. In any case, I'm Ira Epstein. You have a great weekend, and I'll see you all on Monday.